Let's bring in Scott Black, who joins us now, president of Delphi Management. Scott, good to hear from you. Thanks for joining us.
Thank you for inviting me, Wilfred.
I wanted to start. We were discussing this half an hour ago around the close, just by asking about small caps, which makes up for quite a lot of the value stocks, of course, in the index. Very volatile week for the Russell, ending up 2% today, but down 3% for the week. What do you make of that volatility?
Well, I make the fact is that the small cap, the Russell 2000 and the 2500 are now at 25 times this year's expected earnings. They've had huge runs off the bottom, and they're more expensive than the S&P. The S&P now is about 23 times the $172 estimate. So, from a standpoint of valuation, it's not cheap anymore. And as you quite rightly point out, if you look at the actual peak on March 15th and the lows yesterday, both the Russell 2000 and the Russell 2000 value were in correction territory. They were both down 11% from peak to trough, even though we had a little bit of a snapback today.
So is it harder for you to find genuine value at the moment, Scott?
It really is, because even as I point out, our average PE now in the portfolio is between 13 and 14 times, and we don't like paying more than 13 multiples for companies with consistent earnings. Most of the stocks we have are, within their recovery high here. So it is getting increasingly difficult, and we don't bend the discipline. Because the markets are 23 PE, we don't move up our price frontier to a 16 or a 17 multiple.
Well, so I guess Lennar sort of fits into the basket. It's still under 16 multiple, but it has had a tremendous climb. All the home builders have done really well with the housing recovery. It's up 142% on the year, and you still see this as a good value play?
Yes, Lennar is still cheap. I mean, I would recommend it earlier, but we closed today at 102.85. We own that one, and Horton, MI Homes, and PHM. But Lennar has got very good growth potential. They're going to do approximately $11.25 this year, which is a 9.1 multiple. The top line should still grow at about 17%. They're going to deliver about 62,000 homes on the year. And their ROE has been shooting up nicely. Last year was 14.5%. Pro forma, it's about 17%. They generate quite a bit of free cash. It's not like a lot of home builders that put more money into land and inventory as they build. So it's a well-run company. They also have a thing called LNX, L-E-N-X, Lennox, which is sort of high-tech ventures related to real estate. And there's over $3.25 in hidden value. Last year, they harvested one of the companies called Open Door, in which they booked a $470 million profit. And the other thing is, we got housing starts roughly at 1.42 million. Lennar and Horton are the two biggest. They have economies of scale in building. They don't have shortages in getting either labor or lumber, et cetera. And the few increases they have, which are mostly in lumber, they're able to pass along. So I think still at a 9 multiple, considering it's less than half the market multiple, Lennar is very good value.
Scott, tell us about the other pick you've gone for today, Nexstar.
Yes, that's the largest independent owner of owned and operated. They're the second largest, actually, of NBC stations. The stock today closed down at 146. Yes, we think they're going to earn about 1550. It's down because normally it's a non-political year this year. That's still a 9.4 multiple, and most of the broadcasters, the earnings cave in after a presidential election. Their revenue is only going to be down a little over 1.5%. They have 198 stations. They're in 8 of the top 10 demographic markets like Los Angeles, New York, and Chicago. They cover the maximum. They have 39% coverage of homes utilizing television sets. They generate over $1 billion a year in free cash flow. And on a price to enterprise value, if you look at enterprise value to EBITDA, it's very cheap. It's selling about 7.4 times trailing. And if you look at next year, they should do exceedingly well. The earnings estimates are $23, which puts it at over 6 PE. They have 370 of the House seats in their district, 90% of the Senate races, and 85% of the gubernatorial races. And just to put it in perspective, the past year that just ended, they did over $500 million in political advertising. So I know some of the O&Os are out of favor right now, but I think if you have a time period more than 6 to 12 months, this stock is extremely cheap. It's well run.
Shepard Smith here. Thanks for watching CNBC on YouTube.